Well, welcome back, everybody, to another episode of Technical Analysis Academy. I'm so glad you've decided to join us today. My name is Matthew Brienen. I'm Chief Operating Officer and co-founder at CryptoCharge.com. We provide crypto education, everything from macroeconomic news, teaching you how to leverage trade, making money whether the market's going up or down, a full learning center so you can understand all of our methods, techniques, and the basics of cryptocurrency if you don't know them yet. We do curated news and a variety of other things. Of course, the CryptoCharge live show Monday through Friday with my partners Dan Habib and Brian Decker. You guys can use code TA Academy for 40% off. Let's get into today's charts. I wanted to talk to you guys a bit about what I'm seeing in the market. We're going to be looking at some weekly charts. We're not going to be just looking at cryptocurrencies. We're going to be looking at the Dow Jones. We're going to be looking at some silver charts, looking at the dollar itself, and then taking a look at the Bitcoin and XRP price charts today, hopefully giving you guys a little bit of insight into what I'm seeing in the markets. So let's get right into it. So starting here at the Dow Jones weekly chart. So that essentially means that every little colored tick on you here you see is a candle, and it's worth 1 week's worth of activity. So if it's yellow, that means it closed down for the week. If it's blue, it means it closed up for the week. If you're looking at this on your chart, it might be green or red. So a lot of people are asking themselves whether they're talking about stocks or the cryptocurrency market. Is the bottom in? How does this macroeconomic landscape fit into this, right? And it's always a battle between looking at the technicals and understanding that the technicals aren't pure as always, right? There's another fact to it, and the fundamentals aren't always as pure as we like to believe. And there's, things that can alter that particular set of fundamentals. So looking here at the Dow Jones, what I particularly like to see in markets is a rebalancing. So I talked about in a previous lesson when support and resistance, how when we break through a ceiling of resistance, meaning a price that an area where price was having a difficult time breaking above is turned into support, that's generally a healthy thing. So in this example here, we can see that we had a difficult time breaking through the Dow Jones in 2018 here in January, again in October of 2018, tried to poke our heads over here in 2019, another failed attempt over here in 2019, and then a breakout in 2020. Now, following that breakout, what we should traditionally see is a retest of support. So pulling back here and then starting to use this level as a new floor of support in order to move higher. That's a very healthy thing to do. Now, of course, we had an exterior event, a black swan event. We had COVID-19 or C19, right? And that caused this very brash crash in the stock market, right? Taking out this level, taking out all of these lows in here, right? A very jarring thing that happened. Now, when we did finally break up and through, what a lot of people would be looking for is a retest of that zone there. A lot of people look towards the previous all-time high and say, all right, we got to retest that. And that is true. We do need to retest the all-time high at some point, which is kind of where we're at right now. But levels aren't so binary. It can be more of a zone and a range that we look for something to provide support or resistance versus necessarily it's this exact price, fill or die, right? So when we're looking right now, there's a variety of things happening on the Dow Jones. We've got the 200-week moving average trading just below there right now. You can see that the last two weekly candles we have here are trading just below that 200-week moving average. Back here in 2020, it didn't bear a lot of relevance, right? We spent several weeks below the 200-week moving average before reclaiming it. This was a different type of recovery. This is considered a V-bottom recovery. But looking in the past, you can see over here in 2016 and in 2015 that the 200-week moving average was respected very well and allowed this market to move higher. Again, same story over here in 2011, used it as support. And you can see over here, and when we got the 2008 breakdown, that it used it as a ceiling of resistance and then a ceiling of resistance back here in 2010 before we were able to break up and reuse it as support. So understand that when we have this breakdown below this 200-week moving average, this could be an early sign that the Dow has significantly lower to go. The big price that everyone's going to look for now is that kind of we're teetering on this crucial level. The 2020 high is going to be this 26,600 or 26,700 level if you want to round up, that people are going to be looking for, because price could do something like this. It could turn over, it could waddle around in here and then start moving significantly higher. But we need to see something change in the macroeconomic landscape first. We need to see the Federal Reserve pivot from quantitative tightening, essentially raising rates and not buying mortgage-backed securities, essentially not being accommodative to the markets, to quantitative easing by making purchases of treasuries and mortgage-backed securities, as well as cutting rates, essentially making credit cheaper for consumers and allowing people to have access to money at a cheaper rate. And that's what the markets like to see. Markets like to see accommodative behavior and quantitative easing. That is what the markets like to see. And we're seeing bearish behavior right now because we're seeing the exact opposite right now. It's not just the US government. We're seeing this in the UK, in Germany, in Europe, right? Everybody's facing 10% or more inflation around the world. The currencies are being devalued. We're going to be looking at the dollar in a bit here, and we're going to see exactly why that is impacting us so greatly. So looking over now on another market, I want to take you guys over to the silver market. Let's go ahead and remove the small Fibonacci range that I had plotted on here earlier for our live stream that we were going over in more granular detail with our members. You guys can see that looking at the 200-week moving average here, that again has either provided a nice ceiling of resistance, unable to break above, right, or a nice floor of support, able to move significantly higher off the 200-week moving average. And after being in this huge consolidation phase for an extraordinary amount of time, so from July of 2020 all the way through May of 2022, finally got a little bit of that breakdown below the 200-week moving average. And although I love to see us pushing up higher, today was actually a record day today, seeing silver up about 7%, which hasn't been seen in a very long time, essentially since we got this big blow off back in 2020 after everything V-bottomed and moved significantly higher. It's showing me that silver also probably wants to move lower. And that probably is going to put us somewhere between the $16.70 range and the $18 range. Now, I do think that we move lower. I think that we are going to start using this 200-week as a ceiling of resistance, and that we start to move back towards this core level towards $16 per ounce and potentially down towards $14. But in the short term, I think that $16.50 should be the next target that most people should look for to either pick up more silver as a long-term hold, whether it's physical or spot price. Now, let's take a look at the U.S. oil chart. And I like to take a look at oil because, of course, we use oil for everything, right? For our cars, for some people for heating. There's a variety of things that we need oil for, but specifically for transportation, we care a lot about. So looking over here at the oil chart, we obviously saw this very big bottom in 2020. The oil futures actually went negative. There was a lot of external manipulation and pressure on the markets to make these futures go negative in 2020. But just like everything else, we saw a V-bottom recovery out and one of the biggest rallies. And again, think about the fundamental conditions that were being presented at the time. The Fed was giving us the ultimate form of quantitative easing, right? We had rates on 0%. Home rates were just above 2%. You could get a home loan for 2.5, 2.6%. People were refinancing left and right because the rates were so freaking cheap. Add that with the fact that the money printer was in full effect, right? Everybody's getting huge stimulus checks. The Fed is being incredibly accommodative to the markets. And that's why we saw a sharp V-bottom recovery and then also huge blow off tops, not just in the stock market, not just in cryptocurrencies, but in a lot of assets, right? Saw things do extraordinarily well during 2020. It was not only just because of the technical setups, but because of that accommodative behavior the Fed was providing to us at the time, okay? So looking over here at the oil chart, I think that oil still has further to fall. A lot of people up here towards the 120 were looking for oil to go higher. I actually went ahead and threw my Fibonacci on here and said, nope, that's a 786 up here, which is a perfect retrace. Unable to break above, we are going lower. Told our members to start getting short, starting to short from that 120 to 110 range, and we've been short ever since. So regardless of this here, right, we could always retrace a little bit higher. Technically, looking at this left to right, this is higher highs and higher lows, but this looks like a bit of a blow-off structure to me. This looks like a price that was not meant to be sustained for long periods of time. And just like a lot of other assets, this 200-week moving average can be a little bit of a pivot zone, right? We're either going to trade above and use it as a floor of support or trade below and use it as a ceiling of resistance. So right now, that 200-week is right around $63 a barrel. That would also coincide with this level over here, right? If we look at where it is right now, that's a perfect support level, right? You could see that unfortunately we're able to break over here in 2019, all through 2019, 3 failed attempts, set back down, teetered and contended with this area in 2021, eventually turned it into support, right? Multiple examples of us moving significantly higher after catching this as support. But we have not completed, in my opinion, this distribution structure. So I think oil continues to work itself down until we get down towards this $63 region. We're watching for additional opportunities to add to our position over there at cryptocharge.com. Now let's take a look at the dollar price chart. And DXY is the ticker on this. If you don't track this, I don't care what you're trading. If you're into foreign exchange, cryptocurrency stocks, you should have DXY on your charts. It is an actual crucial element to understanding what's going on with the dollar, which in turn impacts every other currency in the world. And you guys can see that the 200-week moving average, again here, has provided either a ceiling of resistance or a floor of support. And back here in 2022, after we kind of saw a little bit of bottoming in topping out in most markets, that the dollar started to move incredibly parabolically, right? You can see it just used this 200-week moving average as a launch pad, and there hasn't really been a retest of this area since then. Looking back in the history too, when we look at kind of where I got this Fibonacci range from, let's go ahead and just remove these moving averages really quickly here. I'm going to take you guys out to a 3-week chart, so every one of these ticks is worth 3 weeks worth of activity. You can see here that looking at this example, let's go ahead and just redraw this so that everybody's on the same page here. Back here in 2001, the dollar was at its absolute peak. It was trading at 120, okay? And if you look at where the dollar bottomed out, it was back here in 2008, the financial crisis, right? The housing bubble popped. We had synthetic CDOs. We had individuals who never should have had loans to begin with, piling up too much inventory, right? And all that ended up being a huge culmination in a credit squeeze. So when we look at this from a swing high to swing low, which is how we draw our Fibonacci's, you guys can see that in this example that we've pierced up over the 786, and that's generally not a good sign because we don't want to see the dollar appreciate, especially if we're invested in stocks, cryptocurrencies, metals, or otherwise, because that essentially means that there is a high devaluation rate of those assets. So breaking up over these three numbers, the 618, the 702, or the 786, shows that there is a lesser likeliness of trend continuation, meaning that the trend was down from 2001. We would have liked to see a rejection from this 110 level. Instead, Dixie pumped to 114. So that's not a positive situation for us, right? So what we need to look for next is, now that we've pierced over the 786, had a strong 3-week close, essentially almost monthly close over the 786, we're coming back to test some of these levels now. The first area that we need to pay attention to, this 110 level, 110 and a half, that's going to be that first test. If we start to hold that as support and we start to build a floor of support there, we're going to move higher towards 120, 121, the previous all-time high from 2001. That, of course, is going to send Bitcoin significantly lower, the Dow Jones significantly lower. There's not enough places to hide, right, if that does happen. But if we're unable to reclaim 110 as support, then we'll maybe see a slow step down, maybe towards 106 and 102 to retest some of those levels. 102 will be a key retest at some point in the future. But again, this depends on the Fed pivoting or not. The rest of the world right now is also begging the Federal Reserve to switch course because of what's happening. When we hike here in the United States, of course, it affects the overnight rates that go to banks, and in turn, they give us higher interest rates, whether we're looking for an auto loan, whether we're looking at a credit card or a home loan, right? All those things are affected by the Fed's fund rate, and that affects us directly as consumers. We're less likely as consumers to spend money if credit is more expensive. It is the Fed's way to punish consumers by making credit more expensive. But the byproduct of aggressive hiking in an inflationary environment like we have now is an incredibly strong dollar, and that's not a problem until you realize what it's doing to other currencies like the euro and the pound and the yen right now, because those countries are producing countries. They make things for other countries. So the advantage they've always had with their currencies being worth 15 to 30% more than the US dollar means that the depreciation they've seen from a strong dollar means that those goods now cost them 15 to 30% more to make, right? So this is now affecting economies, not just here in the US, but in the UK, in Germany, in Europe, right? All over the place. The strength of the dollar is affecting the world in a negative way and could induce recessionary-like conditions. So when we look at this chart, it tells us a lot, right? It tells us what's happening with the dollar. It shows us how we are trading and performing in relations to previous highs. But it also, when we use something like a Fibonacci range, it could tell us, hey, is there a strong probability of continuation to the downside, or are we seeing a breakout? We're going to see significantly higher prices. The upside to this, meaning if we break over 121, the Fed continues to hike regardless of recessionary conditions, regardless of what's happening around the rest of the world. The Fibonacci's tell us that 152 is next for the dollar. And looking back historically, the last time we saw anything like this was back here in 1984 when the dollar was trading at 164. And you guys can see that 1.618 brings us just below that previous all-time high. So where we are right now, could this be a fake out? Could this be a spike over the 786 and the Fed has to pivot at some time in the near future? Yes, it's possible, but I don't think it's likely. I think the Fed continues to ruin things further before we see recovery. Okay, let's take a look at the Bitcoin price chart here. We're going to come out, we're still on our 3-week chart. So let's get down to a 1-week chart here. Okay. And let's understand where we're at. So a lot of people are, speculating that, well, we're on top of the 2018 high, that, iconic high between, $18, $19, $20,000, right? You kind of have these big spikes up here, and we're just teetering on top of that, building a little bit of a floor of support here. But again, this is with the Federal Reserve backdrop, with the aggressive rate hikes, with the quantitative tightening. So, when we look at also, again, the 200-week moving average, you guys can see that we're trading below it. We broke down below here over in June, set some pretty deep lows around 17.5, pull back up towards the 200-week moving average, poke above for several weeks, convincing traders potentially that a retracement is coming, and then move significantly lower. So now we're 1, 2, 3, 4, 5, 6, 7, 8 weeks now trading below the 200-week moving average. We don't have a lot of price history on Bitcoin like we do on the Dow Jones and a lot of other assets, where we can say, well, we have 15 or 20 examples of how this asset has behaved at the 200-week moving average. But with Bitcoin, we only started printing the 200-week moving average in 2019. So we have an example in 2019 of the 200-week moving average being well respected back here 2 times and then used it as a launch pad higher. Back here in 2020, actually barely closed 2 candles below the 200-week moving average, but still used it as a floor of support to send us on to the second largest bull run that we've had in Bitcoin. And now we're seeing an example where the 200-week moving average is still being used as a pivot zone, right? You guys can see that there is clear rejection here that happened over these 5 weeks, but it's not being respected like it was back in 2019 and 2020. So if we are going to obliterate this high, what is the next area of interest for Bitcoin? It's going to be down here. It's going to be around 12,000, 11,050. Some individuals want to go ahead and put their prices up here towards 14K, and that's not a bad spot to layer in some longs. But the range that you're going to be looking at is between $11,500 and $14,000. That's going to be the breakdown area if we do get it. Now, there is, of course, the possibility of a retracement, because generally what Bitcoin has done in the past is come in for a retracement, like back here in 2018. You can see that over here. Let's go ahead and just actually remove everything off of our charts here. If we go ahead and look at the retracement back in 2018, you can see that we capitulated from our 2018 high, worked our way down, but after we capitulated, we came back up for a retracement, meaning that we don't make a new all-time high, but we at least retrace and rebalance the market. And this was a 618, which is the golden ratio within Fibonacci theory. We usually look for a 618, 702, or 786 to be the area where short sellers look to professionally short, right? And you can see that price turned over from there, used the 200-week moving average as support, and then was able to break out significantly higher. But again, this was on the heels of the Fed being incredibly accommodative with quantitative easing, right? So we have different conditions now, right? We're below the 200-week moving average. We're trading in, a very bearish fashion without a retracement. If we look at what Bitcoin should have already done by now, as if the bottom is in, right, is that Bitcoin should have moved up somewhere between $50,000 and $54,000. This is what a regular retracement looks like, right? We start to work our way up, move up here, but then turn back over on ourselves. But unfortunately, the macroeconomic environment is not providing for a retracement right now. So retracement does have to come in at some point, but I think that we're going to see something maybe like we saw over here, where we get another capitulation move, we waddle along sideways, maybe longer than we have previously, and then see some sort of retracement, and then the market can move on to the next bull run at some point in the future, okay? Let's take a look finally at the XRP price chart before we close out today's show. Looking over here at the XRP price chart, we saw something recently that was relatively positive in the short term, but didn't really provide us with the breakout we're looking for. So I've talked about previously with XRP with the Fibonacci video that I did teaching you guys how to use Fibonacci's, and just to kind of give you guys a revisit on that, if we look at the swing high to swing low over here, we can see that these Fibonacci's are respected in a variety of ways. The all-time high over here at the 55 extension, using the 2.618 as support, using the 34 up here as resistance. You can see all kinds of extensions and retracements that were used either as a floor of support or a ceiling of resistance at some point in the past. And you can see that most recently we broke down out of this structure, right? A lot of people were looking for this flagging structure up here on this Bitcoin weekly chart, and we're like, okay, this looks pretty good, right? We popped up out of this huge flag up here. We got this, little flagging structure going on up here. This is what's going to go ahead and provide us our breakout. We're going to go ahead and probably see a breakout up here towards $5, $18, or $13, right? That's what everybody and their mom is looking for on these charts. But when we look over here at the XRP price chart, we obviously got the breakdown with the rest of the market. This is not immune to the rest of the market. A lot of people say, well, my asset's different because this is bear market proof. There's not a bear market proof risk on asset. That's an oxymoron, right? And I know that Peter Schiff likes to think that metals are risk off, but they behaved a lot like risk on assets like stocks and cryptocurrencies, both in 2020 when we had the hyperinflationary environment and everything was moving up together, but also in the bear market, we saw gold and silver get punished quite severely off of their all-time highs, right? So understand that when you're investing risk on assets, there's not my risk on asset is better in a bear market than your risk on asset. There's just the volatility that comes with your asset class. So looking up here, we got this big breakdown below the 8 Fibonacci, this 47-cent mark, came up, actually retested this as resistance. And this might not seem net positive to you in the short term, but what this tells me is that I, for several months now, have had buy limits down at 21 cents and 25 cents. You can see historically that the 4.236 and the 3.618 have provided excellent tops. You can see over here in 2017, this was the first top before we had the second blow off top, but those areas will generally get retested. So what I'm looking for is a break back down to these levels and then consolidate around here, create an accumulation structure, and then move significantly higher. And this breakdown and retest of this 8 confirms that we're likely to get lower prices. This is now going to most likely be a ceiling of resistance, and then we're going to go ahead and test those lower prices. Now, the positive side of that is it really gives us a nice setup for some significantly higher prices. We've seen Bitcoin do a full 377. We've seen a lot of other assets do a full 377 Fibonacci extension, and that lies right around $22. And I really think that is a reasonable blow off top price for XRP in the next bull run cycle. I think it's going to finish between 13 and 22, leaning towards 22. But if you look to even pick up a good sized bag, even if you've been accumulating XRP for a while, and let's say you get right in the middle here, let's just say 23 cents to split the difference. If you look at that from that price all the way up to this cycle top, that would be a 9,200% return on your investment. Okay. That is getting eerily close to a 100x, right? So I want you guys to understand the opportunity that's out there right now. This is the exact opposite of how everyone in the news wants you to feel. They want you to feel doom and gloom, that this recession is going to take 3 or 4 years for us to flush it all the way out. It's likely going to be a depression, right? But we can see the Federal Reserve and a variety of other governments flip on a coin when conditions are met and things get too out of whack, right? We didn't plan to do what we did in 2020. What broke in the markets prompted the Federal Reserve to switch course, right? So when we look at this situation here, it's entirely possible that we have to still go through some more pain. Maybe it's 6 months, maybe it's 12 months, but at some point, whatever breaks, the Federal Reserve is going to have to turn the money printer back on, start to be accommodative to the markets, and we'll see a new bull run begin, okay? I hope you guys appreciated what we covered today, and if it was helpful, go ahead and drop a comment below with any questions and or comments. Again, you can use TA Academy at cryptocharge.com for 40% off. See you guys next time.